Hey, Jason here. Today's video, we're going to continue going over Widepoint. So far, looks like a great investment. We're 21 pages through the annual report. We're going to continue going through that today. Before I get to that, though, I need to let you know you can get this series of podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video here on YouTube, make sure to subscribe, hit the notification bell so you're notified every time we release a new video, and releasing videos all the time. Okay, mini disclaimer here, because I've already done disclaimer on Widepoint several times, but this is not investment advice. Anything you hear in here is not investment advice. It's for your educational purposes only. Do your own homework when you're researching any stocks, but I'm doing this to show you the process I take when I look through stocks, when I look through any potential investments, to make better investment decisions. In this video, and the other videos, I'll show you exactly what I'm looking for when I read through the most recent 10K, including red flags, potential good things. Last week we talked about net operating loss carryforwards and how you can get a huge legal informational advantage over other investors by understanding what those are, how to find them, what they mean in a real world sense, and how they can add an enormous amount of value to the company's valuation. Today, for now, we're going to keep going over the 10K, and we'll figure out what we are going to find. Okay, so there's my base. There's my email. Don't want that. Want this. Okay, let me bring up the screen one more time, make sure we got everything in here. We do not. And source 2, we want display 2, source 1. There we go. Okay, now we're situated. Okay, over here, we have the notes. Again, I'm showing you exactly step by step what I would see, or what I see when I go through these financials, to help you better spot potential red flags, learn how to read financial information better, all that stuff. So these are the notes over here. Again, real world notes with my notations and explanations. If you want to see these notations in the past videos, you can find those in the links below. Okay, we left off talking about net operating loss carryforwards last time on page 21, on the bottom of page 21. So we're going to continue going through the 10K today, and we're going to continue going through the risks right now. This could be a big one. Again, like I said last time, I know this can be a big deal. Government shutdowns, bureaucracy, government contracts. I know this can be a big deal with my excuse me, my dad being in the military. I grew up as a military child. So I know this kind of stuff. If you did not, this is something that I would take as a note, but this is something to keep in mind, specifically this federal government shutdowns. What are those? For those outside of the U.S., these happen on occasion when our politicians here in the United States decide to act like children and not get what they need to get done. So our government shuts down and government contracts go away for a time being, and blah, 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 blah. They always get fixed, but it's usually after some wrangling and maneuvering and all that. Same thing up here with the debt ceiling. What is the debt ceiling? It's to raise the ceiling of the debt, so the U.S. can take on more debt to pay its bills and blah, 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 blah. Again, all that stuff, political crap, I will leave to another discussion. Well, probably not, because I don't talk politics, but contracts awarded through a competitive procurement impact our operating results. Okay, so what this means, and again, I know this, but if you don't, this is something to note. Government contracts are typically a bidding process, competitive bidding process. And what that means is government contracts are awarded to the highest bidder. Typically, highest bidder, or the lowest bidder, lowest bidder for the contract details. So let's say two companies are involved in bidding on a contract. If one company bids that they can get the contract done with $5 million, and another company says they can get it done at $5.5 million, the government most likely will go with the one that is saying they can do it for $5 million, if the company has even a decent record. What this means, though, is that to do these contracts, let's say you go through that whole contract in your company too, and you bid $5.5 million because to you that's a more realistic cost. You put all the time, effort, money, your team's time, all that stuff into winning that contract, but you lost. All that is now a sunk cost if you lost the contract. That's a cost you have to eat if you lose the contract. And it's not, you cannot be reimbursed for it. So that's what that means here is that what we're talking about here. We may incur substantial costs in connection with contracts awarded through a competitive procurement process. That's what that really means, is that there will be sunk costs. Again, this could be $5,000, this could be $50,000, depends on the size of the contract. Probably even go higher than that, I would imagine. But if you lose the bid and you did all that work, you lost all that work, you lost all that time. And that is a cost you have to deal with as a government contractor. Again, I'm going to scan through these. If you didn't see the previous videos where we're digging through the 10K here, I'm going to scan through these. Normally I read these word for word, and I recommend you do the same as well when you're reading through your own financial reports. But I'm not doing that here because frankly, I don't want to bore you to death. Okay, again, they have to have security clearances. I know this. If you did not, this is something I would copy and paste in the notes. This is big. Again, I know this, so I'm not going to note it, but federal government contracts contain provisions giving government customers a variety of rights that are unfavorable to us, including the ability to terminate a contract at any time for convenience. There's really not any explanation needed for that, I don't think, but if there is, let me know in the comments below. That means exactly what it says. Depending on the wording of the contracts, the federal government can and sometimes will be able to terminate the contract with no kind of forewarning. Does that happen often if the company's not doing stupid stuff? Not really, but again, COVID happened and the economy stops. The debt ceiling doesn't get raised and the government gets shut down because of our politicians here. That could lead to contract issues. So it does happen, but I wouldn't say it's commonplace. But it does happen. It is a concern because, again, some of these contracts, especially for somebody like Widepoint, that is now, I think, like a $48 million company, if they lose, say, a $5 million contract, that could be a huge deal. So that is, again, something to be aware of. Okay, yes, again, more risks here. Security breaches or cyber security events could result in loss of customers. That should be obvious to pretty much everybody over the last 20 years or so. Actual perceived breaches of security can lead to issues. Again, pretty standard stuff here. They may be liable to their customers for damages. Again, that's pretty common. They require high-speed access, internet access, and they don't have that. It could cause problems. Again, pretty common for pretty much everybody. Defects in their services and platforms could cause problems with the company, with their reputation, blah, 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 blah. Again, this is all, to me, standard stuff. Again, if you watched the last video, I apologize, but for those who did not, another reason I am kind of just scanning over this is because if you did not watch the first video, I think it's part 3, where we started going over the first video of when we started going over the financials. This risk section can be incredibly important, but most of the time, probably 95% plus of the time, the wording in these sections is almost identical to other companies. So what you're looking for here is wording that is off, things that don't make sense. That's mainly what you're looking for here. So all this stuff that I'm looking at right now is pretty standard. So that's kind of why we're kind of breezing through it. If they infringe or are perceived to infringe on tech IP, that could lead to problems. Again, standard stuff. may be unable to protect their proprietary software and methodology. Again, that could lead to problems, of course. Risk related to regulation. So this might be a little bit different than most companies, because with government contractors, there are huge regulations. Okay, that's pretty standard though. Our failure to comply with complex procurement laws and regulations could cause us to lose business and subject us to a variety of penalties. So if they do something against these regulations, they could be fined, they could be suspended, they could lose their government contract status, all that. Adoption of new procurement laws or regulations could reduce the amount of services that are outsourced by the federal government. It causes us to experience reduced revenues. Again, outsourcing is happening pretty much everywhere. So this is not really, I mean, it's just kind of common knowledge at this point, in my opinion. So again, this is not something I would put in the notes. Government audit. Unfavorable government audit results could subject them to penalties and sanctions. Again, pretty standard stuff. Don't do anything stupid. In other words, what this is saying is, as long as we don't do anything stupid, we should be fine, is what pretty much this entire risk section is about. Common stock has been volatile and likely will be volatile in the future. That, again, you'll see that pretty much every company, especially you'll see this for smaller stocks like this one though. Again, this line right here, general economic conditions and events including adverse changes in the financial markets, terrorist attacks, health pandemics such as COVID-19, government shutdowns, war, adverse weather events, and other disasters. That is almost word for word what you'll see in pretty much every single company you look at when it comes to these specific risks to their stocks. Future sale or shares of our common stock may negatively affect our common stock price and or be diluted to current shareholders. This you see on occasion, typically for smaller stocks. This you need to watch, especially for smaller stocks. You don't want share dilution to become a massive problem. If it does, it could literally destroy stocks. I've done videos at this point. I think one stock, and I can't remember what the stock was, but one stock I showed you guys, and this was just the basic preliminary stock analysis that we're doing. They had massive dilution in it. Over time, it destroyed 99.7% of the value of the company. Again, I cannot remember what the stock is off the top of my head, but share dilution, especially for smaller companies, can literally kill the company. So this is something to watch. Again, I've known this for a long time, so this is nothing news to me, but if you didn't know this, I would put it on the things of note section or the risk section. This you'll see on occasion as well. A third party can be prevented from acquiring shares of our common stock at a premium to the market price because of our anti-takeover provisions. Okay, let me scan through this. Okay. So this just protects them. These kind of things are also, depending on how strict they are, called poison pills. It's to keep people away from taking over the company. But generally, if it's a friendly takeover, this kind of stuff can be situated. This is more for the hostile, quote unquote, takeovers, where things aren't necessarily as friendly. They don't expect to declare any dividends in the foreseeable future. Again, that's not a risk to me. It's not even a thing of note. Most small companies don't pay dividends. But if you are counting on a dividend, this would not be the stock for you for that reason. Okay, so this is interesting. So the properties, they rent their properties. Fiscal Street lease. Okay, these are our U.S. and international locations. I want to take a note of this. It's not as huge of a deal because they're renting, but it's still something you want to know if they own the properties. However, this could be a huge deal because, again, we're looking for legal informational advantages over other people. So what you could do is search this address, and I've got videos showing you how to do this. Search the address, search up the tax records, figure out what the property is worth based on the tax records, and then you could either add that to the value of the company if it's depreciated off their balance sheet, or that also could add, let's say these combined worth $10 million and they own them outright. As a $48 million company, that's a huge margin of safety because, in my opinion, because that means they're worth at very absolute minimum, let's say $10 million in this case. I found companies with properties that were worth $500 million and they were completely depreciated off the balance sheet. Dole, I think they have between, if memory serves me right, when I owned them years ago, I found that they had between $500 million and $1 billion in valuable land in Hawaii that they've owned for like 100 years, and it was completely depreciated off the balance sheet. Wasn't counted on, meaning it wasn't counted on the balance sheet as value at all. So that added another $500 million to $1 billion to their value estimation for what I was doing then. Okay, so this right here, holders as of the close of business on March 12th, 2021, there were 95 registered holders of record of our stock. What this means is there are not only there are more than 95 shareholders, but these are people who have actually registered their shares and that they own them, and it's not in the brokerage's name. What does that mean? So if you own shares at a brokerage, it means the brokerage technically owns the shares unless you register with the company that you own their shares. So not really a huge deal to my knowledge. I've never registered a stock or that I've been a holder of stock because at this point I haven't owned more than 5% of any company, so I haven't had to. I don't think this is a huge deal. But again, if you didn't know that, that's something to kind of watch out. Okay. This is interesting. Okay. So on August 18th, 2020, we entered into an at-the-market issuance sales agreement with B. Riley Securities and other companies, blah, 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 which establishes an at-the-market equity program pursuant to which we may offer and sell shares of our common stock from time to time as set forth in the sales agreement. The sales agreement provides for the sale of shares, aggregate offering price up to $24 million. Why am I highlighting this? Because that means they can issue $24 million worth of stock. That is a massive potential share dilution because, again, as of right now, their entire stock right now is worth like $48 million. So this is more than adding about, what, 1/3 of the value to the company, diluting potential dilution risk of about 1/3. I'm going to add that to the risk section over here. And I'm going to continue taking or reading this. At the market offerings, what does that mean? That means it at market price. It's not a premium, it's not a discount. That means it's typically should be at or near the market price when they're selling it then. Okay, again, this, so they sold almost 400,000 shares for just under $5 million. So again, not a huge deal, but share dilution of, at that time it wasn't 10%, but now it's 10% of the company value because the company's stock value has fallen. Back then, the share price was higher, and I'll show you in a second. But this could be why their shares are falling in the last year, which I can show you because I have up right here. So since I first talked about the company on, I think it was April 7th, was the date. Company shares are down 43%. And they fell recently on August 16th. They released their most up-to-date quarterly earnings, and we're going to take a look at those as soon as we finish the 10K. But that could be, this dilution could be part of the reason why their shares are falling. And again, we need to do more research to figure out what's going on there. This is interesting. All right, let me get back to the notes. Nope. There we go. Okay. They did a reverse stock split late last year. Increase the number of stock from, okay. So they reduced, what they did is their share price was likely at a tiny amount, and they need to have it, for example, on certain exchanges, you have to have an above $5 per share price for, I think it's like 60, 90 days. Or if you don't have an above $5 per share price for 60 to 90 days, you can be delisted from the shares, from the exchange. There we go. When that happens, a company typically, companies' shares typically craters. So a company, to avoid that, can do what's called a reverse stock split to lower the number of shares outstanding, which increases the value of the company's shares on an individual basis. This economically doesn't really do anything to the company, but it does mean they're doing some kind of financial engineering, and I don't mean that necessarily in a bad way, because again, this isn't always bad, but it is something that I want to know about so I can research further. What happened, for example, before October 23rd, 2020? So let's go look. And these are adjusted. So what happens on these, for example, these are adjusted. These stock charts are adjusted. So I would have to go back and find their unadjusted stock chart to see what their share price was before then. But it's most likely because their share price was below $5 or something like that, because that's what a lot of small companies do. They have bought back shares. That is, frankly, very surprising for a small company. And they have $2.1 million remaining under their 2019 repurchase program, which does not have an expiration date. That's important because most of these have an expiration date. But they have bought back some shares, which means they think the company is massively undervalued. And again, we're going to continue figuring that out if that's true. But when a company buys back their own shares, it typically means they think the company is massively undervalued. They purchased almost just under 1 million shares in 2019. They can repurchase more. Interesting. Okay, again, so we've gone through some of this. In the first video, video number 3 in this series, where we started looking at, which you see some of this stuff over here, but it is slightly different. So again, just so I have this info, making sure I don't have the exact info. It's very similar. And again, I warned about this in video 3. You're going to see this kind of repeat, and that is happening. So I'm not going to put this because I have, or at least this top section up here, because I have this in notes already. This I will take because there is new information here. The strategic focus section. Managed services, high margin. When you see high margin, that means high profits. When you see high profits, that means typically or it could mean potential competitive advantages. Working to focus on the following key goals in 2021. Growing sales pipeline. Okay. Longer-term strategic focus and goals are driven by our need to expand our critical mass. What does that mean? What does that mean? Our longer-term strategic focus and goals are driven by our need to expand our critical mass. Why? Well, A, what does that mean? B, why am I highlighting it? What that means in a real-world sense is they want to expand their capabilities so they can do, down here, more sales and marketing. It also means for government contractors that they may be looking to acquire businesses that have access to other contract vehicles that they are looking to expand on or that they're looking to work on. And actually it says that to expand our marketplace share and increase the breadth of our offerings, to improve company sustainability and growth. So they're looking to diversify. They're looking to do all these things. I'm highlighting that, and I'm going to put it in the notes section in probably the general info. That's not necessarily a thing of note. It's just, again, so I kind of remember it. And again, it says it directly pursuing creative and strategic acquisitions to expand our solutions and our customer base, blah, 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 blah. So what this really means is, again, they're working to focus on higher margin businesses, diversification, and to expand their sales and marketing efforts to continue earning more and more and more and more and more and more contracts. Okay. Okay, you want to read these very carefully. Critical accounting policies and estimates. You want to read these very carefully. Like with the risks section that we just went over. Like with the risks section, these are very, very similar across companies. Very similar wording. And they should have very similar wording. If they do not, if they have weird wording that you either do not recognize or doesn't make sense, you need to figure out why. Why do you need to figure that out? Because again, if they do not have similar wording, it means, or it could mean, they're trying to do some funny stuff with their accounting numbers. Specifically, ones to watch out: revenue recognition. This is a big one to watch out for. And we'll go through here because I don't expect them to have kind of any weird issues here, but we'll see. But if the reason you want to pay special attention to revenue recognition is because depending on how a company recognizes its revenue, it could lead to what is called aggressive accounting, which can lead to other problems on the entire balance sheet and potential fraud and all that stuff. Again, I don't expect to see that here, but watching revenue is very, very, very important in this section. And I'll tell you when I'm reading this word for word here, and I'm going to tell you when we get to the actual section to pay attention to. This is important. Again, not necessarily anything of note because I've known this for a while, but if you do not, in the event there are undelivered performance obligations, our practice is to recognize the revenue when the performance obligation has been satisfied. What does that mean? So when they have done their job, that's when they recognize the revenue. They don't recognize revenue before they've done the job. They don't recognize revenue as soon as they get the contract and they're waiting to do the job. They do it when their performance obligation has been satisfied, meaning they perform by their contract and they've done what they said they're going to do. That's when they recognize revenue. This is, again, this line right here. we're going to see what this says throughout, but this line here is a good sign. It means they are conservative in their estimates, and they're doing not even necessarily conservative. They're recognizing things as they should be recognized. You shouldn't be able to, or you shouldn't recognize revenue in most cases until after you've done the work. Because if there are chargebacks, if there are refunds, if there are things like that, you could be in trouble because you may have to pay that money back and you may not have it if you've recognized it. Okay. Again, important here. Revenue is recognized upon the completion of the delivery of monthly managed services based on our user or device counts or other metrics. So again, after their clients, they and their clients have done the work, that's when they recognize the revenue. Even if they get paid, let's say on the first of the month, they don't recognize that revenue until the 30th. Is probably similar to what this means, or something along the lines of what this means. Again, this is conservative. This is by the book. This is good. Okay, revenue is recognized in the next section in identity services. Revenue is recognized from the sales of identity credentials to an individual organization upon issuance, less a portion deferred for monthly credential validation support services. So again, once they've actually done what they say they're going to do, they recognize the revenue minus a deferred monthly credential validation support service fee. This is good. Again, this is what they should be doing. An example of the two above of what might get them into trouble and might be a red flag is revenue. Let's say this one up here said revenue is recognized upon the signing of the contract. Typically, again, unless there's some kind of upfront fee, you shouldn't do that because there might be chargeback, there might be refunds. You might not perform your duties. The client might not perform their duties, depending on what the wording of the contract is. Especially for a government contract, you have to be very careful. You need to err on the side of conservatism, and this is what this is showing. Software revenue sold as a term license is recognized ratably over the license term for the data software is a customer. Okay, that's standard. All this is standard, so all this looks good to go for now. And again, the reason I'm being so careful here and actually reading this word for word is because this revenue recognition, I've seen companies that were doing that I was excited to potentially invest in. Then I got to this section and they were doing some crazy aggressive accounting and I completely stepped away. So not only is just kind of on the face level, knowing what people are accounting for important and how they're accounting for it important, it also gives you an idea of how much you should or should not trust management as well. If they're doing super aggressive accounting, that's probably a sign they're doing some other not great stuff as well, in my experience. We recognize revenues for professional services performed based on actual hours worked and actual costs incurred. Okay, again, standard. Okay, all this is standard. Okay, so that's very good. That's, again, I've evaluated, I wouldn't say a lot, but when I do evaluate companies and I do get somewhat excited about investing in them for the long term, That is a section you need to be very careful with. I've seen lots of companies that I didn't like going into that. So that's a big thing that I look at. Okay, I'm going to scan here because, again, this goodwill section is pretty standard for every company. Impairment testing, typically once a year. They go through how they do the test for impairment. And then typically this section down here is the most important, because this above this paragraph is pretty much standard across the board. But down here you want to read very carefully. We had approximately $18.5 million of goodwill as of December 31st, 2020. Fair value of our single reporting unit was above carrying value. Accordingly, we have concluded that goodwill is not impaired at December 31st, 2020. So that's good. Another important section to look at: allowance for doubtful accounts, or allowance for bad debts. Something like that is usually what it's termed. So that's a little bit longer than most companies, but it's not unexpected. 120 days. Customer account balances outstanding longer than 120 days that have not been settled in accordance with contract terms or receivable against the existing allowance terms, or, I skipped the line. They write off the reserved accounts after 120 days if they can't get in control into contact with the people. Again, that's pretty standard. You'll typically see 60 to 90 days here. 120 days is not a surprise. Why did I say that's not a surprise? Because typically in the governmental space, things take longer. So I'm not surprised it's long. But again, typically you'll see 60 to 90 days here. Share-based compensation. Again, Black-Scholes option pricing model. We see that pretty much everywhere. We already talked a little bit about net operating loss carryforwards, which we're getting into here. And this we saw last time. I think it was like 7.9 million, but they released 8.2 million, probably to cover fees and stuff like that in total from their NOLs last year, to cover, so they wouldn't have to pay taxes on that amount. So again, standard stuff here. This is a breakdown, obviously, of their different business lines, and then the total number. We have carrier services up here, managed services, and then various operations of managed services, and the total revenue down here. Revenue jumped up huge 2020 from 101.7 million to 180.3 million. So that's, I would want to know if that's going to continue or not. So possibly will not. This is important right here. This is very important right here. So important, I'm going to double highlight it. So again, we need to figure out if that huge 2020 is going to continue. Our services, our carrier services, increased primarily due to, important word there, which I'm going to underline. Primarily means that was a major reason, due to activities of the U.S. Department of Commerce contract supporting the 2020 census. Why is that important to know? Because the U.S. Census is only done once every decade, once every 10 years. So 2020 numbers may not continue. So going up, this was carrier services. This doubled, so I wasn't going to note this, but now I am, with the further context, is a huge jump in 2020 carrier services from 68.7 million to 137.6 million in 2020. That, at least to a large degree, that huge jump will not continue. It's not, usually I say maybe in these cases, it will not. Again, 2020 censuses only happen every 10 years in the US. So, and it actually goes further. The carrier service revenue recognized from 2020 census project was approximately 61% of our total carrier service revenue in 2020. Okay, so let's go back to this, and that, actually I should move these, now that I'm looking at it, down here to risks, way down here. Go back up and grab the other one, which is right here. The reason I'm moving these to risks is because this is a massive risk. What we need to do here is we need to figure out specifically what 61% of that number is, 137. So 137, 640, 019 times 61%. So that's 83,960,000. So 3 640 019 minus, and I forgot the number already, which I knew I was going to do, 640 019 times 61%, so 83 million. Let me write that down this time. 83,964, 2 rounded up. So 137,640,019 minus 83,960,412 equals 53 million. So they actually, the revenue without that huge amount from the US Census was actually lower by about $15 million. Lower. And I'm going to put that over here in the notes. Revenue in 2020 without the census contract was 53.68 million, or about 15 million less than 2019 numbers. So that's a huge thing to figure out. Am I comfortable with that? So I highlighted that in red down here because that is massively important. Massively, massively, massively important. So let's go back to there. Let's go to their financials. Again, this is the same exact process I would go through anytime I'm looking at a stock. So that would take their total revenue down in 2020 by these numbers are not correct, doesn't look like. They are. Okay, so at a huge ramp up in revenue in the last 5 years or so. What their real kind of revenue number, recurring revenue number was last year, 3,015 minus 83,960,412 equals. They actually had lower revenue last year without this huge contract than they did in 2019. So let's go back to the notes. 2019 revenue without census So that was carrier services. This is total revenue. Was 9682, or about 5 million less than 2019 full year company wide revenue. Okay, so this is 2020 actually. So what does that mean? Again, this affects everything. So when revenue lowers, and we should expect it to lower substantially by about 61% going forward, this lowers operating profits. This lowers free cash flow. This lowers the value of the company, because over the long term, companies are valued based on the profits and the cash flows they produce. So see this huge jump in revenue here. By my guess, we're looking at probably, if they won some more contracts, between about $90 and $120 million in full year 2021 revenue. That's a huge drop from last year, and their margins were okay last year, even in the best case scenario. So I would say this is more likely closer to their operating profit margin at 1%. That would be my guess. That's their kind of real quote unquote operating profit margin, would it be about 1%. That lower revenue, again, you see this huge jump in revenue in 2020 from 2019. That's why, because they had that huge extra contract they won't have anymore. Same thing, I'm assuming, with cash flow. Actually, no, cash flow is about a little bit lower, actually. But that affects the entire valuation of the company. We will get to that next time. I think this is a good place to stop here. Yeah, this is a good place to stop here.